Hello, this is Conrad Invest. Thank you for 230 subscribers. I'll try and make the videos better. Hopefully it's been useful. So in today's video, I'll be covering the valuation of some of my stocks as well as how I value my different companies. So based on valuation, there are mainly four different methods that I use. So the first one is your ROIC and PE method. This one is in an article that was released by Credit Suisse. Basically, you just compare the ROIC and the justified PE for all these different companies. The second method is your EPS and terminal multiple method. Basically, you forecast the EPS growth over the next few years, and then you put a suitable terminal multiple at the end based on the predictability, based on relative, or based on the historical history of this company. Next one is your price to operating cash flow and terminal multiple. So this one is for companies that have they are experiencing high capex cycle now. So for example, your Microsoft, Amazon, and Google. This method over here will be suitable for them. And then the last one is your discounted free cash flow analysis. This one is for companies that have low capex. So for example, S&P Global, Moody's, and maybe MasterCard and Visa. All these companies, you use the discounted free cash flow method. So let's talk about the first method first, which is your ROIC and PE method. So over here, let's say I got two companies. Company A is 20 times earnings. Company B is 10 times earnings. Company A has 20% ROIC. Company B has 4% ROIC. So let's say they both make 100 million every single year, and then they reinvest $100 million. So in 10 years time, company A will have $300 million in earnings in total. Company B will have $140 million of earnings in total. So 10 years later, assuming they have the same market cap as they had 10 years ago. So for example, over here, company A will have a $2 billion market cap, whereas company B has a $1 billion market cap. Then as you can see over here, company A will have a 6.66 price to earnings, whereas company B will have a 7.14 price to earnings. So as you can see over here, in the long run, if you want your companies to basically compound in returns, you want to find companies with high ROIC, even though they look artificially more expensive now. So if I had to compare between, let's say, a company that is trading at 30 times earnings but having like a 20-30% ROIC as compared to another company, maybe a consumer staple that is trading at 10 times earnings and having an ROIC of maybe 2%, it is not viable, it is not economically viable for you to invest in this consumer staple company as compared to this company that has 30 times earnings. Because this company that has 30 times earnings, they'll be able to give you incremental returns over time by reinvesting its earnings. And that's what you want for your companies. And if you were to look at all these big tech companies over here, you have Google, Amazon, Microsoft, all of them, they are basically in the range of between 25 and 30 times earnings. So if you're to just look at this table over here, they should be somewhere below this table, maybe around a 27 times to 30 times earnings. And that is why all your different Max 7 companies, they demand a higher multiple as compared to all your different other S&P 500 companies. So I don't think these Max 7 companies, they are overvalued yet. In fact, I think some of them are undervalued. I'll cover it later on. Don't be disillusioned by the fact that they have a higher multiple as compared to all your different other S&P 500 companies, because they are much higher quality. They have much higher ROIC as compared to your other companies. If you're interested in this one, you can look up Terry Smith. He talks about ROIC a lot. So let's talk about Microsoft. So Microsoft's EPS and terminal multiple. So Microsoft's current valuation is around a 31 times earnings. The lowest valuation in the past 5 years is around a 26 times earnings. And the earnings growth is around 14% over the next 5 years. So as you can see over here, Microsoft is down around 16% from all-time highs already. It was at one point in a bear market, and now it's in a correction territory already. So why did I put 14% growth? Because based on their capex, their expected growth, basically using their reinvestment rate, the expected growth is around a 14%. That's assuming all the capex pay off, but of course the capex won't pay off. So maybe 14% is maybe too high, but I'm just sticking to the 14% because that is what every other analyst is forecasting as well. So if you're to look at just Microsoft's valuation over here, if I put a 14% EPS growth, 26.4 times earnings, which is their lowest in 2022. Currently, Microsoft is around fair value. So its fair value is around $400, undervalue is around $360, and then the overvalue is around $440. And currently, I think Microsoft is a decently safe bet. You will get either market returns or maybe slightly above market returns for higher quality business as compared to the market. So if I were to compare between buying the S&P 500 and buying Microsoft, I would stick to Microsoft. Microsoft is the more durable business. For your S&P 500, there are many companies that are just junk companies like some healthcare companies and all that as well. So Microsoft today is fair value. If you want to buy into this company, I think it is a decent entry position right now. Next one is Google. So Google over here is currently trading at a 20 times earnings. Lowest valuation in the past 5 years is 19 times, and then the earnings growth is around a 15% over the next 5 years. So if you were to look at just Google's growth over the last 2 years, last year it grew earnings at around a 30%, and then the previous year from that it grew earnings at around a 20%. So 15% over the next 5 years is definitely more than achievable for this company. And if you were to just look at the stock price, currently it's close to a bear market already. So it was again at one point near a bear market. It was in a bear market at one point. It was down around 25% from all-time highs, and now it's down around 20% from all-time highs. So for Google over here, if you were to just put a 19%, 19 PE for this company, and assuming a 15% EPS growth, this company will give you around a 13% CAGR. That signals some sort of undervaluation as compared to the markets. So I think Google right now is currently very undervalued, maybe around a 20 to 25% undervalued. And then the fair value is around $210, whereas the overvalued range will be around $250. Maybe I'm being too overly bullish on Google, but I think Google is a company that is underappreciated in this market. And once it gets appreciated again, like it did a few months back, the multiple could go up to a 26, 27 times again. Next one is Amazon. So Amazon current valuation is around a 35 times. Its lowest valuation in the past 5 years, past 10 years, it's around a 35 times, which is today's valuation as well. And the earnings growth is projected to grow about 20% over the next 5 years. So why is it that I put 20% for Amazon? Because for Amazon, the story is extremely simple. They can grow revenue at around 10 to 12% every single year, and their margins are exploding. So if you were to look at the margins for AWS and everything else outside of AWS, it's been exploding over the past few years. And this year itself, this year and last fiscal year, they grew around 90% in terms of their earnings. So I think a 20% for Amazon, assuming the economy just stays where it is now, is extremely achievable for this company. So same thing, same story for all your different Max 7 companies. They're down around 20% from all-time highs as well. So for Amazon over here, the current EPS is around 5.53, and assuming a 20% EPS growth over the next 5 years, and assuming a 30 PE, I think a 30 PE is more than reasonable for a company that is growing at 20% every single year. Amazon will give you around a 15.6% CAGR. Of course, if I change the EPS growth to around a 15%, then Amazon's price right now will give you around a 11 to 12% CAGR. That is also undervalued for this company. So for me, I think this company is currently trading at fair value right now. Maybe I'm getting too overly bullish in terms of the growth estimate. So I think it is currently fair value right now. The undervalued range will be around $160, whereas the overvalued range will be at around $240. So if you're to just look at Amazon from an operating cash flow perspective, currently their operating cash flow is around 18 times, which is the lowest in the past 5 years as well. Of course, they're growing much lesser as compared to the past already. In the past, they had extremely explosive growth. But if you're to just put an 18 times operating cash flow multiple for this company, and assuming the operating cash flow goes at 20% over the next few years, then the CAGR for this company, you can expect a 20% CAGR for this company over the next few years, which is extremely high. It is almost market beating already. In 5 years, you can grow your capital by 100 to 150%. That's just incredible for this company. So I think Amazon right now is fair value. If you want to buy into this company, it is a decent entry point as well. Next one is Visa. So Visa's current valuation is around a 34 times. Its lowest valuation in the past 5 years was just a few months back. It was around a 27 times. And then the earnings growth over the next 5 years is at around a 13% EPS growth. So for Visa over here, if you were to just put in all these different estimates over here, assuming that PE is at around a 28 times, and then assuming 13% earnings growth over the next 5 years, Visa gives you around a 9% CAGR, signaling that Visa is maybe slightly overvalued right now. So I put the fair value for Visa at around $300. Overvalued will be around $340, and then undervalued will be around $260. So for Visa over here, this is my discounted cash flow valuation for this company, because this company doesn't have much capex. So as you can see over here, the discounted cash flow analysis gives me a fair value for Visa at around $270. So currently it's around 10 to 20% overvalued. So it is 11% free cash flow growth, because it is slightly lower than the EPS growth, because they do buybacks as well. So they use their free cash flow to do buybacks, and that inflates the EPS. So EPS at 13%, free cash flow at around 11% is more than reasonable for this company. So for Visa over here, it is an overvalued company, but it is a high quality compounder, and the valuations are not crazy right now. I think a 40 times earnings for Visa would be crazy. Currently, it's at a 34 times earnings. So I'm holding this company, I'm not selling it. I don't have a very big position in it. I want it to be around 10 to 15% of my entire portfolio, but currently it's around 4% of my current portfolio. So I'm not adding. It's currently overvalued. It is a company that is extremely high quality, so I won't be selling it. I'll just be holding it and allowing it to compound over the next few years. Next one is S&P Global. So S&P Global's current valuation is at around a 40 times. Its current price to free cash flow is 28 times, and the PE is elevated due to its IHS Markit acquisition. So they acquired another company called IHS Markit. They paid around a 38 times earnings for that company, and that's why the PE multiple is slightly elevated as compared to the past. So if you're to just look at S&P Global over here, I think if it commands around a 35 times earnings, and assuming it grows its EPS at around a 13% over the next 5 years, in fact, I think it can easily grow EPS at around 15% over the next 5 years. Because you have your debt war maturity that is coming up in 2028, it could easily grow at 15 to 17% EPS growth over the next few years. And assuming a 35 times earnings, S&P Global over here will give you around a 10% CAGR over the next few years. So using the EPS calculation, S&P Global is around fair value right now, and I would say the overvalued range will be around a $600, which is at around a 20% above today's price, and the undervalued range will be around $440. That will be where I'll be adding heavily into this company. So if I were to just use the DCF valuation method for S&P Global as well, currently S&P Global's fair value is around $521. So that is assuming a 12% free cash flow growth over the next 10 years, which I think is extremely doable for this company, assuming that all the economic conditions stays constant, because if your IHS Markit, which is growing at around 10% revenue every single year already, and then you have the ratings portion, which is exploding until 2028, and then after 2028, will start tapering down again. But I do believe that they have extremely strong pricing power in that division, and that will allow them to continue growing over the next few years. So for the markets in general, I think the markets are slightly overvalued right now. We're currently at a 28 times earnings, and I do think that the fair value is at around a 20 times earnings. That was what happened in the 2020 crash from the 2021 boom. So hopefully the market comes down even more. That will be around 20 to 24 times earnings. That will be the time for you to add.